Welcome to this Killick Explains video, and this is another example where I want to analyse the results of a recent Twitter poll I did, which had very good participation. I want to draw out some lessons that are relevant to long-term investors, particularly stock market investors. Now, anyone wanting to find my Twitter handle, it's TimEditorKillick, all one word. That's my Twitter handle and the polls are there. But let's take a look at a recent one and see what conclusions we can draw from it. So the question that was asked on April Fool's Day was, which of the following statements is the most foolish? So let's start with an answer that attracted 11.4% of the votes, if you like, and that is that inflation kills shares. Now I understand why a lot of people might think that, particularly more novice investors, if you like, because the last 10 years have seen inflation at record low levels around the world, and stock markets, barring hits from the recent pandemic and so on, barring those, stock markets have done pretty well. So a lot of people will be drawing the obvious conclusion, well, low inflation is good for share prices, so surely the reverse must be true. But it's not as simple as that. Historically, if you look back across different time periods, different markets, the picture is actually more nuanced. It's not a straight line relationship. Yes, a sudden burst of inflation would probably be bad for share prices in the short term, but then sudden shocks of any sort tend to be bad for share prices in the short term, so that's not saying very much. Yes, a burst of inflation can have an impact on consumers' willingness to spend. It reduces the real purchasing power of their income and so on. It can be bad for savers on fixed incomes because they can't do anything about it, so some pensioners are disadvantaged from rising inflation. Now all those are valid arguments, but on the flip side, it can be very good for some firms. Commodity prices, for example, will tend to lead the way as we head into a more inflationary cycle. And depending on the type of company and sector you're looking at and the exact market, whether inflation remains overall good or bad is quite a mixed picture. There's certainly no straight line conclusion you can draw. So inflation doesn't kill shares unless you get a sudden spike, in which case, yes, it's reasonable to expect you might get a dip while the market adjusts to and prices in new inflation expectations. Next on the list, short selling must end. Now, 11.4% of people went for that one, but quite a few other people thought that's not a good statement either. Why not? Well, short sellers have been in the news recently for all the wrong reasons, some would say. These are people who bet on share prices falling rather than rising. I won't go into the exact mechanics here, but essentially they sell high looking to buy back low later. So most people assume that you have to buy first and then sell later. Short sellers reverse that idea to make money. And quite a few investors who are not familiar with it think, well, this is pretty immoral, isn't it? This is betting against companies, betting against directors and so on. But actually, short sellers are a more complicated beast than they might first appear. For starters, they are taking a contrarian position. Stock markets over the long term have tended to rise, so anyone betting against them is automatically taking a contrarian position. Secondly, their losses are potentially unlimited. If you bet on prices falling, they can rise against you an almost infinite amount. So the amount of profit you can make is actually limited to the point where you put the down bet in and zero, whereas your losses, if you get it wrong, can be unlimited and they can spiral very quickly in what's called a bear or short squeeze. And thirdly, short sellers have to be therefore very confident in their view. And why would they be betting on share prices falling? Could it be that the directors of the company they're looking at have got it wrong? The capital invested in the business they're looking at would be better off invested elsewhere. So some would argue they're actually doing the markets a favour, weeding out weaker companies and just accelerating something that should have been inevitable anyway. Statement number 3, value investing is dead. 17.1% of the people who responded to the poll, there was a lot of people went for that one, the rest didn't. And I'll come to the winning answer in just a moment. Value investing is not dead. Sometimes value investors, pure value investors, slip out of fashion. So there is a school of thought that says there are growth investors and there are value investors. There are people who go for cyclical, non-cyclical, if you like, and the people in this hand, the sort of value investors, non-cyclical, slightly more defensive stocks, those people have had a hard time over the last 5 to 10 years. And it's true. Growth stocks, if you're thinking about technology, healthcare, biotechnology and so on, have put on something of a march. But to say value investing is dead would be a stretch, to put it mildly. Value investing's core principles, as espoused by Warren Buffett, by Benjamin Graham going back far enough in security analysis, by the likes of Charlie Munger, Terry Smith, famous fund manager in the UK, those principles never go out of fashion. So even if you're looking at growth type stocks, value investing principles, the bottom up analysis is absolutely vital. It doesn't go away. And anyone who just chucks value investing principles out of the window and effectively bets purely on momentum with no regard to value or price is going to run fairly quickly into sticky situations. So value investing, yes, pure value investing may be due something of a comeback in its conventional form, and we're seeing some evidence of that already. But as for the idea that the techniques that underpin value investing, as the idea those that are ever dead, well, that's a stretch too far. So the winning answer was actually IPOs never fail. And we have seen examples of this recently. 60% of my respondents to the Twitter poll came back with that one. So that's the silliest statement of the 4. And yes, it may seem as though as a wave of unicorn and technology stocks came to the market over the last few years, that IPOs, new offerings of shares, companies coming to the public markets for the first time, it seemed like a one-way bet. But I have discussed in the past why unicorn stocks, as they're known, private companies that are valued above a certain level in US dollars that come to the market quickly, why they can be dangerous. And we have seen evidence of that in some of the more recent issues in the equity market. Okay, IPOs are underwritten, they have backers in the form of investment banks, there are some guarantees there, but no one can guarantee that IPOs will simply be companies that come to the market and then storm up the share price charts, if you like. No one can guarantee that, so even if that seems like the latest trend, be careful. And we've seen evidence that bringing companies to market can be fraught with challenges through the use of special acquisition vehicles, SPACs as they're known. This is an attempt to circumvent the normal IPO rules, bring companies to the market another way, and quite a few of those have struggled. So those people who said that IPOs never fail, of the 4 statements on offer, is the most foolish on April Fool's Day? Well, I tend to agree. I think that is correct. So there we have it. Some lessons from another Twitter poll, and in future Killick Explains videos, I'll be taking other results and just deconstructing them and pulling out the lessons for investors. Anyone who'd like to watch videos on one of the 2 of the topics that I mentioned, killick.com/learn. There's a library there and a sort of menu that you can look through to identify the category of video you want to watch. And anyone looking for something written, a bit chunkier, my How to Invest in Equities guide is also available. editor@killick.com would be a good place to email me if you're interested in a copy.